The market is down over 14% year to date, and it's created some interesting opportunities. I'm going to look at two of those opportunities in this video, which includes Sprouts Farmers Markets. It's probably a name that you haven't heard me talk about on this channel before, but we do track it as part of the Patreon group. And the other company that I want to cover, it's one that you guys absolutely love me talking about, is Alibaba. So that's what we're going to dive into in this video. So guys, as always, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the mission here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it, because you guys already know that the market is down over 14%. You can see here where year to date it just hasn't been great. And of course, you guys know why that's happening, because you can see from this headline on the Wall Street Journal that the Federal Reserve actually increased the interest rates by 50 basis points, which has been the biggest rate hike since 2000. But the scariest part is that after the Federal Reserve raised interest rates by half a percentage point, Federal Reserve Chairman Jerome Powell said that the central bank expects additional 50 basis point increases, which are on the table for the next couple of meetings. Now, I understand that they're on the table, and to be honest, they're always on the table because you don't know what measures are required to slow down runaway inflation. However, at this point, I dismiss those as almost like hawkish sentiments, but nobody really knows what's going to happen in those next few meetings, but it's very interesting to see how this plays out. But one thing that I do want to point out to you guys, that although you guys can see here that officials have broadly agreed that additional half-point increases could be warranted in June and July, given the current economic conditions, we are seeing situations where the economy is slowing down now. So I would be a little bit cautious. Do they increase rates by another 100 basis points before even the end of this year? I don't know if that happens, but if it does happen, how much more does this slow down this economy? And can you really orchestrate a soft landing in the economy and not trigger a recession with such aggressive rate hikes? I don't know how that plays out. But the one thing that a lot of people will point out is that the reason why they believe that it's realistic that the Federal Reserve can increase very aggressively is, if you look here, you can see that the federal funds target rate is still at historic low levels. However, from the perspective of someone who was investing through these last two rate hike cycles, so you can see that there was one rate hike cycle right before the 2009 recession, and there was another rate hike cycle right before COVID. One thing that you will notice is that in the last rate hike cycle, you'll see that they noticed that they went too far too fast, and they actually started bringing the rate back down right before COVID in 2019. So be careful. That was a really strong economy. That was an economy before supply chain issues, and that was an economy before heavy levels of inflation. And still, they had to bring the rate right back down after they realized that they hiked aggressively. So we don't really know what's going to happen. So it's going to be a very interesting economic story that's being played out right now. That being said, you can see here that the article went on to say that during the past 80 years, the Federal Reserve has never lowered inflation as much as it is setting out to do now by 4 percentage points without causing a recession. And in addition to that, we now are dealing with lockdowns in China. We're dealing with military conflict, as you're seeing in Ukraine. So there's a lot that can go wrong here. I find it very difficult to believe that we're going to orchestrate a soft landing. However, I remain cautiously optimistic. I might be too optimistic here. That being said, one really interesting data point that came out last week was that the April hiring remains strong. So we added 428,000 jobs in the US. And so the hiring market remains strong, which means if the hiring market is strong, that means that the consumer spending market is also expected to be strong, assuming that people aren't hoarding cash, which they could be with the anticipation of a recession in the future. So we'll see how this sort of plays out, but that's a good data point. More people are going to work. And that makes a lot of sense because there's such a significant labor shortage that those wages are going to be raised to bring more people back into the labor market. And you can see those increases in wages are really impacting the leisure and hospitality industry. And so what you're really seeing here is that the wage gain growth is being led by the lower end of the wage spectrum. So that's good, but also keep in mind that it's also not a good thing at the same time, because if wage rates are going up, then that means input costs for employers are going up. And so that means costs for employers are eventually going to have to go up, which get passed on to the consumer, which only flames inflation. So we'll see sort of how this plays out. So what has this economic environment done to the companies that we have been following? Well, you can see here that of the companies that we're following, you can see that it's been a brutal 1 month for a lot of companies. Obviously, Shopify, native to Canada, we have two really phenomenal companies that we love, Tim Hortons and Shopify. And you can see here that Shopify is down over 40% month to date. I personally still think Shopify is a little bit expensive. If you join the Patreon, you can see my valuation model on Shopify. I think this continues to go down. I think it continues to go down a lot, but we'll see how it plays out. But other two companies that I did want to point out is one, you can see third from the top, Sprouts Farmers Market is actually down 29% month to date. But note that in the last week, they're actually down 21%. So the question is, what happened to Sprouts Farmers Market in the past week, which caused the share price to crater? We will cover that in this video. But the other thing that I want to point out to you guys, so you can see here as this is sorted by the weekly returns, Sprouts Farmers Market is actually one of the leaders of the companies that declined the most over the past week. Like I said, they're down 21%. And then the other name that you guys are familiar with, Alibaba, actually declined 11% on the week. And so, of course, you guys can access this model and get access to the 1 week, 1 month, and 1 year returns for all of these companies on the Patreon at the $5 per month rate. And like I say to all of you guys all the time, if you decide to subscribe and enter into that $5 pledge and you decide that it's not for you, no problem. Just let me know in the Patreon app that it's not for you and I'll completely refund your first month subscription. In fact, I believe that Patreon just does that automatically now. They don't charge you until the end of the first month. So you can have access to everything for the first month completely free. So there's no risk for you. But moving on, you can see here that inflation has really impacted Sprouts Farmers Market. They reported earnings and they said that inflation is not slowing. Customers are continuing to put fewer items in their baskets. And so as far as their outlook for the year is concerned, they believe that it's prudent to assume a more conservative approach to their outlook. And so what they're really saying is that they are guiding towards the low end of their outlook for the remainder of 2022. And that outlook is 4 to 6%. So effectively, they're guiding to 4% revenue growth. But what's interesting here, you can see here, is that from 2011 to 2021, their revenue growth CAGR has been 18.6%. And so you can see here, this was what they provided at the year end of 2021. Their full year 2022 outlook was only 4 to 6% revenue growth on the top line. So effectively, they're guiding to 4%. So what does this mean? Well, looking longer term, you can see that they're sort of changing up the types of stores that they're going to be rolling out. They state here that they're beginning to deliver unique smaller stores with expectations of stronger returns while maintaining the approachable, fresh, focused farmers market heritage Sprouts is known for. And so from there, they're saying that they'll be able to provide a long runway of at least 10% annual unit growth beginning in 2023. And so you guys already know with retail, there's only two metrics that you got to pay attention to. One is same store sales and one is store count growth. So if they're saying that they're going to be growing their annual units by at least 10% a year, assuming that the same store sales doesn't decline, that means that revenue is expected to grow over the long term at least 10% a year. But if you also have same store sales growth, then you can tick up that 10% to more than that. So if same store sales grow at maybe 3% a year, plus you have your store footprint growing at 10% a year, you can easily forecast, 13 to 15% revenue growth top line every year. That being said, you can see that in my model, I'm actually being very conservative with my top line revenue growth. I'm saying that in 2022, they are at the lower end of that revenue growth spectrum, so 4%. But if you notice here, 2023 and beyond, I'm only growing them at 9%. So effectively, what I'm doing is I'm saying that, yeah, they're going to get that 3% same store sales growth, plus they're going to be growing their footprint at 10%. So maybe around 13% top line revenue growth, but then I'm bringing it down for conservatism reasons. So I'm giving them 9% growth only. So effectively, I'm growing it very low relative to their long-term guidance, which I'm comfortable with. And that brings me to my valuation, which of course you can get as a Patreon subscriber with that conservative revenue growth approach and a low terminal multiple of just 15 times, which I think is low for a retailer at this stage in their life cycle. The valuation for this company is $43 per share. And with the current share price of $24 per share, this company is trading at approximately 56% of its intrinsic value. However, I do want to point out something to you. I tend to be a very conservative investor. So I want to show you this here. We absolutely love Sprouts Farmers Markets. It is a company that we have been paying attention to for quite a long time. And we love this company for many, many years, but we refuse to pay anything above $20 per share for it. And this is one of the reasons why, because I do believe that there's enough risk built into their business model that the share price can decline. And we now see that inflation showed up as one of those risks and it brought that share price down. But once again, I'm being conservative here. I do want to buy it for under $20 per share. Now, a lot of you guys might think that that's wishful thinking. That's okay. I'd rather make the mistake of omission than the mistake of commission. But I always like to look at the cash secured puts because I might be able to enter into this opportunity at $20 per share, and it may not happen now. However, I can enter into an options contract where I get paid for that now. So you can see here from the cash secured puts, the approximate 1 year out, June 16, 2023 cash secured put at $20 can net you a premium of approximately $3.50. And so you can access this cash secured put tool, which gives you a simple put yield of 17.5% and a net purchase price of $16.50, which is absolutely phenomenal, by the way. But the real kicker here is that the put yield is approximately 15.8% or 16%. So that's really exciting. I can enter into this right now and get paid to enter into a bet to purchase Sprouts at a price that I'm really looking to buy it, which is at $20 per share area. So no matter what, it's a win-win. Heads I win, tails I win. But the other thing is this cash secured put analysis tool is available to all the Patreons at the $5 per share level. So you can go in and put different puts in and it'll give you the annualized yield. And I always say, never focus on the simple put yield because you can see here that the simple put yield is saying that you're going to make 17.5%. However, that's because it is greater than 1 year's time. And there's always an annualization factor with selling options. And because the time is greater than 365 days, on an annualized basis, you're making less than that 17.5%. So I always like to think of it from the perspective of what is the time weighted return that I'm generating. And here it's lower than 17.5%. It's 16%, but it's still acceptable. And so it's something that I would be interested in entering into. The other thing that the Patreons get access to, and this is the most important thing, and the one thing that you should always look out for is with these companies, you can see here that just because the company is trading at 55% of its intrinsic value, which you can see here because you can see the price is $24 per share and the intrinsic value is $43 per share. So one divided by the other, 55%. The other items that you should be paying attention to are the qualitative type areas where the business model has risk. So you can see here, does the company have debt? Well, they have very low debt. So that's fine. It's probably not a big risk, but is the business model inflation resistant? Well, I say maybe. The management just came out and said, well, they're starting to feel the impacts of inflation. Well, this is something that the Patreons and I have discussed on the monthly calls every month for over a year now. And we have been discussing the fact that Sprouts Farmers Markets has an issue with rising inflation with their retail business model, and now we're seeing it. So that is why we've been trying to be very conservative on the share price that we're looking to purchase this company at. And so the reason why I put maybe is because they can roll out house brands that can become more profitable, and thus they can be somewhat inflation resistant with their business model. We'll see if they do that. A lot of retailers do that. Shoppers are generally more willing to switch over to house brands in times of higher inflation. So it generally becomes a win-win for the retailer and the shopper. The other area is, what is the size of their economic moat? Well, Sprouts Farmers Market, you're generally getting a less price sensitive customer. And the thing I always say is inflation is different for different people. If you sit at home and just make YouTube videos all day, higher gas prices do not impact you the same way as they impact someone who maybe installs windows for a living and has to pay that higher gas price to get to the customers' homes. So inflation impacts different people differently, and less price conscious customers are higher up on that socioeconomic scale. And so they might be less willing to switch retailers, which means that Sprouts Farmers Markets might have a stronger economic moat. However, there's a certain point where everyone's going to switch over to the Walmarts or whatever the lower priced retailer. So I just threw a maybe there. And then the other thing that I've been looking into more is I'm seeing this more and more with companies. So I just want to point this out to our investors is if you're going to use a free cash flow model to value the companies, you need to understand what that share-based compensation as a percentage of the free cash flow is. So I do point out that I asked the question, and you can see this on the far right, is SBC greater than 10% of free cash flow? So is share-based compensation, that's what SBC stands for, greater than 10% of the free cash flow? If it is, you might want to think about deducting share-based compensation from the free cash flow that you calculate to calculate something that to correlate closer to what the earnings are that the owners will get from it. So that's what Warren Buffett talks about when he talks about like owners' earnings. So something to think about here. I try and adjust for it in all of the models. So if you do join the Patreon group, you will see that in the models, when I do rely on free cash flow valuations, I am generally deducting stock-based compensation as a real expense. Now, moving on to Alibaba, one thing that we're really noticing now is that bulls on Alibaba are getting less optimistic on the name. You guys have been seeing on this channel the whole time that I've been discussing Alibaba, I've been talking about the rewards as well as the risks. And the fact that I talk about that on a balanced perspective, it does cause my channel to grow slower than it would if I was just a total bull. But with that being said, you're now seeing other bulls become less optimistic on this name. So you can see here that Stephen Roach, who's been a long-time China bull, says there's no way that Beijing or China will meet its 5.5% growth target. And you guys already know that 5.5% GDP target, it already had built-in monetary policy easing into it. And so that's how China was expected to get into it. So they were going to inflate their way a little bit into economic growth. Well, now, even with that included, analysts are now coming out and saying that it's probably not going to happen. So a slowdown in the Chinese economy is set to have global ramifications, Stephen Roach warned, with Beijing now unable to bail out the world the same way that it did after the global financial crisis. And I agree with him. I think the zero COVID policies in China have now reached a very critical scale where I do believe that the possibility of the Chinese economy going backwards in 2022 is a very real possibility. Although maybe around that 20 or 30% likelihood right now, I think if they continue with these current policies, they probably will go backwards in the year. But not seeing evidence of that just yet, but I do believe that it's a very real possibility. And you can see here, their shares have declined as a result of factory activity contracting. So Chinese economic data that was released last weekend showed that in April, factory activity contracted. And so moving on, you can see in this article, they said that the official purchasing managers index for April declined to 47.4, which was a second straight month of contraction following the March reading of 49.5. And this is data from the national government. And so the 50-point mark in the PMI readings separates growth from contraction. Now, because that's data that comes out from the government, you always like to look at data that's not from the government. And so a private survey also showed a contraction in Chinese factory activity, with the Xiaxin Market Manufacturing PMI coming in at 46, declining from the previous month's reading of 48.1. And they go on to state that Omicron and the government's zero COVID policy were the main culprits for China's activity declining in April, halting industrial production and disrupting supply chains. And from this, there are analysts that do believe that there will be global ramifications. You can see here, a sharp Chinese economic slowdown in the second quarter remains a realistic outcome at this stage if history is any guide, and so a global hit to growth would follow shortly after. So this is what at least one analyst is now predicting. And Beijing is doubling down on their zero COVID policies. You can see here that Chinese leaders are threatening actions against critics of their zero COVID policy. So you can't even criticize these policies anymore. The government was going to come after you. And so what is this doing to Chinese companies? You can see here that Alibaba's shares remain at their 52-week lows. There's no reprieve for the stock. Investors want this thing to run. It's not going to run in light of current economic conditions. And so what exactly does that say for their cash secured puts? Well, you can see here that the $100 January 19, 2024 cash secured puts are now trading at around $29, but they could return back to that $30 cash secured premium level in the near future. And you guys remember I did make a video where I did double down by selling the $30 cash secured puts for the $100 exercise price for January 19, 2024. It was a really good yield for me, and I will link to that video to explain that whole position at the end of this video. And once again, I do want to show you that here you can see that Alibaba is trading at approximately 30% of its intrinsic value. The company has no debt. It is inflation resistant, or at least its platform is inflation resistant. But the one thing that I do want to point out is as we look at their qualitative characteristics, the economic mode, I have signaled that the economic mode is a medium. And the reason why I say that their economic mode is a medium is because even Alibaba has come out now and said that they're experiencing competitive impacts in the Chinese online purchasing environment from new online entrants and competitors. So I do expect that that will continue into the future. That's a real risk for the stock right now. But this video has been all bad news, and the environment is not really that bad. I'm actually a net purchaser in this environment, and you guys know that I was a net seller in 2021 into the strength, and I got up to around 70% of cash in my portfolio. But in 2022, I've been a net buyer. I've actually been buying a lot of stocks, and my cash position has significantly moved lower. And so you can see here from the companies that I'm following, you can see that Alibaba, of course, we mentioned in this video, they're trading at 30% of its intrinsic value. And Sprouts Farmers, you know that they're trading at 55% of their intrinsic value. But there's another 27 companies on the companies list that I'm following that are trading under 75% of their intrinsic value. And so, of course, I do point out other issues. You know, are they inflation resistant? Do they have debt? What's the size of their economic moat? And is their share-based compensation greater than 10% of their free cash flow? And so you can see most of the companies, their share-based compensation is less than 10% of the free cash flows. So it's very interesting to get access to the Patreon, to look at this list, see sort of what is cheap, what industries are sort of worth buying into, what seem more like value traps. Very interesting to look at, and then dive into the models related to those specific companies, which you can click into. When you click into the ticker, it takes you right to that model, which is in the same spreadsheet. So very interesting, important to get access to right at the $5 per share level. And like I always say to anyone, if you're not interested after a month, no problem. Fully refund your money. But with that being said, I think it's very important for you to take a look at how I doubled down into Alibaba. That video has done really well. I think that a lot of you guys have been interested in it. And so if you haven't seen that video, I think it's very important to see sort of like how Alibaba bulls are sort of diving into this environment and generating additional cash flow while the shares remain depressed. And so you can get to that video right here.